Hello guys, welcome to Smart Money Trading course. In this video I'm going to discuss the difference between smart money trading and retail trading. I think all of you has come from a background of retail trading, and now we are switching to smart money trading concepts which will help you win high risk reward ratio trades and earn more money. So starting from the basics, in retail trading you have learned that you trade from support and resistance or trend lines. In support and resistance, what you do is that when the price bounces back from a certain level, you draw support lines and you place your trades when you see a bullish candle here, and take your profit levels here, putting stop loss below it. And when you see a continuous resistance from this zone, you place your trades here, putting stop loss just above the resistance line, placing stop loss just above the resistance line, and taking your take profit levels here, like this, just like this. And in trend line, what you do is that when you see a continuous support from this level, you place your trades here, putting stop loss below the trend line and putting target levels below it. This is a basic way of trading where your risk reward ratio is not so high, because as you see a bullish candle here, you place your when you see a bullish candle here, you place it, putting stop loss below it and targeting these highs, maybe, or maybe a few. So 1:1.5, 1:2, 1:3, a general form of retail trading where you win but you don't win much, and the win rate is around 50-60%, so that not too much profitable. From profitable point of view, retail trading is much less profitable than smart money trading. And when you understand the concepts of smart money trading, you will identify the zones where the retail traders put their stop losses and target those zones, grab the liquidity of the retail traders and bag your money. Just as simple as that. From retail trading point of view, when you see these zones, you understand that retail traders put their stop losses just below this level of support, and this just above this level of resistance there is a huge amount of money. So you could understand that there is a huge amount of money, placing above and below it. As a smart money trader, you know this. So for most of the cases, you could see that when the price moves in a range like this, taking support from this level, resistance from this level, support from this level, resistance from this level, most of the traders sell from this point. You wait for this liquidity to be grabbed, as there is huge amount of money, just as I've shown you here. So we wait for this liquidity to be grabbed. The price comes back to test the untested zone or unmitigated order blocks here, and then the price shoots up. So as a retail trader, what have you done is you put your trades here, you might have put your stop losses below it, you might have put your stop losses above it, targeting this level. What happens is that your stop loss got hit, and then comes your breakout strategy. When you see a breakout here, what you do is that you place another trade here, putting a stop loss below it, maybe targeting 1:2 or 1:1.5, then again your stop loss got hit. So this is not a smart way of trading, where you lose huge amount of money, and when you win, you don't win much. So as a smart money trader, when you see this zone, you could identify this as either an accumulation zone or distribution zone. So accumulation zone is the zone where the market movers put their buy orders so that the price could shoot up rapidly. So after this, you could understand that the price might should go up and up. And distribution is just the opposite. What happens is that after this distribution zone, the price shoots down. So these are the areas where the market movers place their orders, trap the retail traders, and make the market move according to their desired direction. So as a smart money trader, you could understand that there are a huge amount of money resting above and resting below. You wait for the price to break this zone so that you could understand the direction of the market. And what you wait, you wait for the unmitigated zone, for the unmitigated order blocks here, and you place your trades, your limits here, putting maybe stop loss below it, or putting your stop loss below the order block and targeting maybe this high, or targeting maybe this high. So you could see that you win much more than the retail traders, and you win with a high risk reward ratio. So this is the case. And when you see a trending market, like this, you could understand that there is trend line. When you see this trend line, you could easily understand that the retail traders put their trades there, putting stop losses below it. You wait for this stop losses to be grabbed, this liquidity to be grabbed, and the trade to come to this unmitigated zone, to this order block, and then make the market move. So what you do is that you could identify this this trend line as the liquidity. When you see that there is a rapid move in the market, the banks are waiting for the price to come to this unmitigated zone or to this order block and then make the market move. So they grab the liquidity here and then makes the market move. So I think you have understood how what's the difference between a smart money trader and a retail trader. And now I'm going to show you a few examples and you could clearly understand. So you could easily understand how the market makers move the market and understand their way of trading. So coming to the examples. Hi guys, now I'm going to explain to you how retail trading is different from SMC trading from live charts. This is a stock named Mahanagar Gas Limited, and here I'm going to show you how charts play out and how you trade as a retail trader and how you trade as a SMC trader. When the price moves like this, it consolidates for nearly, you may say, 17 days. When the price moves like this and consolidates for 17 days and it breaks this range, you can see as a retail trader that it creates a range like this. It creates a range like this, taking support from this level and resistance from this level, and it breaks slightly, and after that candle it breaks with a massive move. You place your trades here, you place your short positions here. When you're too risky, you place your trades here, maybe 1:1.2, maybe your ideal trade as a retail trader, and the trades doesn't play out. It hits your stop losses. But as a SMC trader, what you do is you wait for this candle to break, so you understand this area to be a distribution zone, and you understand this area to be a distribution zone, and I mark this as the area of distribution. You identify this as area of distribution, so the banks place their orders here, short Mahanagar Gas Limited in this zone. As they short, they trap the retail traders here, hitting the stop losses. Now, as a SMC trader, you could see that the market moves rapidly down. The market moves rapidly down, creating areas of liquidity. See, you could identify these are areas of liquidity, as you can see wicks here. So you identify this as area, and you identify this as area of liquidity. And then you see here in this area of supply that there is an order block, which I will cover in the next videos, how to detect the order blocks and what are the confluences. Just here I am showing you how SMC trader place their trades and win most of the times with high risk reward ratio. So as a SMC trader, you could see that the market moves like this, creating huge amount of imbalances. Imbalances means that the market moves rapidly and inefficiently. If the market moves efficiently, it will move here, come here, move here, come here, move here, come here. But it moves inefficiently, creating a lot of imbalances, which I will cover in the next video. Don't worry. I am just showing you. So here is imbalance. Don't worry, I am saying you again and again. I will cover everything in the coming video. So as a SMC trader, you place your trades here. You could see there is an order block here. This is my point of interest. So place your stop losses just above this order block. You see that it breaks this with break of structure. It creates more liquidity here. Now it taps into this zone, and for your partial profits you could target this zone, and this could book partial positions, yeah, and the rest of the positions till this. See how this trade played out. If you're a risky retail trader, what you do as a retail trader is that you place your trades here, putting your stop losses just above it and targeting 1:2. You hit your stop loss here. When you see a strong candle breaking this consolidation zone, if you're not a risky trader, when you see this candle breaking this zone, you put your stop losses maybe above this candle and targeting this zone. What happens is that you have to wait longer. Your risk reward ratio is not higher. So these are the problems of a retail trader. But as an SMC trader, you are much more cleaner. Your trade works faster, so you don't have to put your capital for a longer period of time, and you win with a higher risk reward ratio. See, you can't imagine for most of the trades as a retail trader that you win 1:6. But as an SMC trader, 1:3, 4, 5, 6, 10, 12, 15 are normal trades. 1:4, 5, 6 risk reward ratio is a very normal trade as an SMC trader. So in this trade, I am showing you how breakout from a zone works out in SMC trading. And next I'm going to show you how you're going to place your trades in a trend line moving market. Now coming to the trending market, I have already shared this trade on Instagram. I did not create the Telegram channel then. It was on 21st February. So as a trader, you could identify this as a trending market where the market is creating higher highs, higher lows, higher highs, higher lows, and again higher highs, higher lows, higher high, higher lows. When you see this higher high and then another higher low, another higher high, another higher low, and the market is clearly breaking this structure, okay, and creating a trend line here. As a retail trader, what you do is that you place when you see the market is breaking this high taking support from this level, another high taking support from this level. So you place your trades here. As you place your trades here, putting stop loss below the trend line and you take profit levels here, what happens is that your stop loss got hit. But as a smart money trader, you could identify these as a major break of structure, and you see imbalances here because the price moves inefficiently and there is a rapid move in the market. So you wait for these order block to be tapped, and you could see it live. There are many traders who could not identify these market structure properly. So you practice these a lot. You will identify these, and I will cover in the next sections how to identify these order blocks. So don't worry, don't rush the process. And there are many traders who identify these zones. So as a retail trader, what happens is that the stop loss got hit once. You delete this. What happens next is that you see a trend line here. You see that the price is again taking massive support from this level. You have your confidence, you take your trades here, putting stop loss below it and targeting again this level. What happens is that your stop loss again got hit. Why this happens most of the times? Because even if it is a trending market, there is an unmitigated zone here. So the price is going to retrace back to this unmitigated zone. And I've already shared you on Instagram on 21st February that the price is going to retrace back to this point. So you place your limits here and you take profit levels here. What happens is that the price taps into this level, makes a rapid move. I've already given you an alert to book your 40% at this level. So it's already 1:2, I think at 1:2. And you place your stop loss to break even. So it's a risk-free trade, and as it moves up you book partials and take your full profit levels in. So as a smart money trader, you win much more. You win with higher risk reward ratio, and you understand the principles and the way the market movers move the market and grab the liquidity and make the money. So wait for those zones to be tapped. You place your orders to that unmitigated order blocks. You place your trades or your limits, and you wait most of the times, because as a trader you make the money in waiting and much less in trading. If you rush your trades, you will have stop losses. So have patience, wait for your zones to be tapped, and you place your trades and you trade only to those zones or levels and you win. So this is the end of this session. Let's move to the next session.